Hi everyone, welcome to Trader Chats, unique perspectives from seasoned traders. I'm your host, Imran Lakha, founder of Options Insight and 20-year professional options trader. As you might know, I became a trading mentor about 3 years ago, but I thought these conversations would be a great way for my students to gain valuable perspectives from some of the professional traders that I know and respect. I hope you enjoy the episode. Okay, welcome everyone to today's episode of Trader Chats. This one's called The Wisdom of Charts. And there was no one better that I could think of to bring on when we're going to talk technical analysis than my good friend Kuda Chinhara, otherwise known as Kay. So welcome, Kay. It's good to have you on. And
thanks for having me.
Why don't you tell the audience a little bit about your background, how long you've been trading, etc., and how we know each other.
All right. I've been trading since officially since 2005, which is when I graduated from the London School of Economics. I'd been studying mathematics and statistics there. I first worked for about 6 years at Goldman Sachs trading equity derivatives. And then after that, took a break for a year, joined Citi, was at Citi for 5 years, which is, of course, where I met you, and we had a few adventures there. But yeah, it's been quite the journey.
And so, the reason why, me and Kay, like you said, we met at Citibank. And before I met Kay, I really didn't use a whole lot of technical analysis, right? I was of the belief, and I started in the industry in 2001, and most of the people that I kind of met or learned from kind of didn't really look at charts in any great detail. They were kind of the opinion the only reason to look at charts is because everyone else looks at them. And there wasn't really much else that they thought they could get from charts, basically, right? And one of the things that a lot of people say is, technical analysis is just a bunch of random squiggles on a chart. Like anyone can draw lines in various trajectories and kind of build any picture or story they want on a chart. So my question to you would be, why do you find charts so important to trading and investment decisions? Okay,
so I think it's worth defining what does a chart represent for starters, right? A chart is a visualization of a time series. So for me, technical analysis is time series analysis, and that is what I studied back in university. In fact, my introduction to technical analysis, or what we may call classical technical analysis or chart analysis itself, that probably came a year or two into my first job. But prior to that, dating back to the time I was an intern in university, it was more statistical analysis for pattern recognition. In fact, the projects I got involved in when I was a banking intern then were along those lines. So when I was introduced to charting analysis, which was through the sort of old school technical analysis that was being done by the team at Goldman Sachs. There was one particular analyst who he had a language that I enjoyed, put it that way. And so it came from questions I started asking him about the techniques that he was using. What I wanted was the data to support the sort of assumptions or views that he had. I remember the very first thing I worked on, he was talking about momentum divergences, which is kind of stuck around for a lot of time. And what I then found is, if you're trying to test these assumptions, test these sort of techniques, there's so many different ways to skin the cat, so to speak, because how you define some of these phenomena or patterns or whatever you want to call it is a massive part of the trip. And then how you play with the information you get out of that is also part, I think, of the art of classical charting analysis. But I'd say my particular take was on testing a lot of what came out from these old school traders, the old school analysts. That really was my introduction. I took what they were saying, tried to codify it, and come up with some sort of statistical backtest or some measure of if there was any sort of predictive signal in what they were saying.
Like you mentioned pattern recognition, right? So that, yes. So the idea being that it's like, you know, the theory being that patterns kind of repeat over time. There's like, yes. And if that's the case, why do you think that is something that you see in time series? Like you see repeating patterns, like is there a logic behind that? Or is that just a coincidence?
We could speculate, right? When it comes to, say, market prices, when it comes to those time series, right? They're a reflection of human action, mm-hmm. right? And as we know, we have a lot of biases. We have a lot of tendencies, which can be reflected in the history of our economic interactions, whether that be some stock market index or maybe through a time series of interest rates or whatever it is. These, it is possible. I'm not saying this as a matter of fact, but it is possible to certainly historically point to those episodes where certain mass public sort of emotion or psychology was driving things.
Like fear and greed, right? Basically, right?
Those are the classic ones people speak of, right? Yeah, that's probably the easiest way to put it. Mm-hmm. When fear or greed was predominantly driving price action, for example. Mm-hmm. Mm-hmm. So yeah, I believe that, yeah, there are certain tendencies that will show up within markets, within price series, based on what those predominant emotions are at any one point in time, right? And they may show up in ways that we don't quite understand, maybe cannot quite measure. But if you've been in the markets long enough, I think a lot of the old school sayings, they come from that, just those sort of observations. Some old school trader who's been around for a long time, for example, and it's just patterns that they notice time and again, right? And then they start saying it, and other people start saying things, and before you know it, something is sort of part of conventional wisdom. But those are a lot of the type of things that I was testing out to see if there was some sort of statistical validity, mm-hmm. To a lot of things that you just hear people say a lot. Right.
And then, what about fundamentals, right? I mean, for those of us who aren't technical analysis gurus, have spent our whole careers looking at this stuff, yeah. There's definitely an argument that the things that are more important in this day and age might be central bank policy or politics or what is the macro narrative that everyone's focused on right now? Is it rates? Is it the dollar? What are the trade flows that are moving markets? Like the retail army that's buying all these meme stocks is just a massive driver. So, how do you think that fits into it? Or is it even relevant at all, in your opinion?
I can tell you how it fits into my analysis. Mm-hmm. So when it comes to economics, I follow the Austrian school, right? For me, that is what best explains everything we see, everything we have seen.
For those who aren't familiar with the Austrian school, in a nutshell, and yeah. I know that's probably not easy, what do you mean by that?
What do I mean by that? Oh my God. how can we summarize this the best? Okay, well, when it comes to the market, when it comes to, say, someone who is active in the market, I'd say the biggest takeaway from me from the Austrian school is the Austrian business cycle theory.
Okay.
That what we have had certainly in the last century or so, in this age of a lot of what we call unsound money, central banking, lots of government intervention, that sort of era, is that this general boom and bust cycle is a direct consequence of artificial credit creation. And it is characterized by often long periods of a general boom in economic conditions. But there is always an unavoidable bust. Mm-hmm. An unavoidable bust, which is essentially where you get a cluster of entrepreneurial error because artificial credit creation results in a lot of malinvestment, mm-hmm. right? A lot of projects that are truly unprofitable at best will get financed during an artificial credit boom. Mm-hmm. But at some point in time, you need to unwind that.
You need to pay the piper.
You need to pay the piper, yeah. Right? So you have an unavoidable bust, and then guess what? You start again. Mm-hmm. So I look at the global economy through that lens. Mm-hmm. Do I use specific things from economic analysis for to try and time trades and whatnot? Not really, right? It is that basic, having that basic background that is effectively during that credit boom, which can last years. It can last many years. Mm-hmm. But that's generally where you have these long sort of trends developing in markets. Mm-hmm. Yes, you have interruptions, but pretty much for a while, you get these pretty strong trends developing. And then at some point, you probably get an enormous bust. Mm-hmm. Right? As nowadays, people are getting kind of used to the idea that the bust can be pretty large, pretty fast, but they can be, relative to the length of the boom, the bust seem to be pretty short, to be honest.
Yeah.
Certainly in terms of when you look at asset prices. But I think that's pretty much as far as I'm looking at the fundamentals, so to speak, right? Mm-hmm. It is identifying or knowing the sort of potential areas where you can get disruptions based on where a lot of the intervention is happening.
Sure. So like it's kind of cycle, right? Like where are you in the cycle, and like we say, a lot of the cycle is being forced by policy, basically, to an extent, right?
Yes. I think if we're looking at that sort of, call it a credit or artificial credit cycle based on central banking measures, yes.
Okay.
Yeah, that is a choice, right? Inflation is a choice.
Yeah.
It's a choice by whoever's running the show.
Agreed. And I get the feeling we're in a world where they're happy to see inflation, but they just don't want to admit it, basically, right? So yeah, but
most likely.
We can go off on a tangent there, but it's like, it's financial repression, right? If they can keep rates low and inflation high, but use CPI as your barometer of what official inflation is, when asset price inflation is like 3 to 5 times that, then you basically just inflate assets to the moon, basically.
Oh, absolutely. If we're going to start talking about central banking, that's going to be a discussion that's going to last weeks,
Yeah,
and
I don't want to talk about
horrible side effects of what they're doing across so many different factors of life. For the middle class, for the poor people, it's a never-ending conversation, right?
It's so funny. I follow a guy called Darius Dale. I don't know if you follow him, 42 Macro, ex-Hedgeye guy. and he cracked me up the other day. He was on Real Vision and he was saying the Fed are now trying to solve racism via their policies, because they're saying they're looking at unemployment of the different sectors like blacks and Hispanics and stuff like that. It's just like,
yes,
what are they doing, right? They're saying
climate change.
Oh, climate change, exactly.
When the hell did such crap become mandate of a
central bank?
You know, it's best not to start.
It's crazy. Anyway, let's move on. So, okay, so you're not really looking sort of day to day what the fundamental news flow is or anything like that. You're looking much more big picture. No. Where are you in the bigger picture cycle? And then outside of that, all your analysis is more around the technicals and the charts. So then the next question I would say is, what type of charting strategies and techniques do you find to be the most valuable? Basically, are there like a handful? Are there like, have you got some favorites that you lean on for your analysis that you have tested and found to be particularly effective at helping you navigate markets, basically?
Okay. So yeah, for me, the whole, it's the process is like baking a cake. You've got different ingredients, need them in the right amounts from your recipe to get something good coming out at the end. So I can briefly describe the inputs into how I'm looking at the market, right? So I would say, if we have that big fundamental picture running in the background, first we peel the first layer of the onion, then would come actual cyclical and seasonal analysis. Mm-hmm. And within that, I am looking for what are generally repeatable patterns in terms of the market ebbing and flowing, whether it's the shorter term bull and bear markets. You know, a classic cycle for people to study, to look at, is the so-called kitchen inventory cycle, discovered by an economist back in 1923. He was looking at various things such as interest rates in Great Britain and the US, I think some commodity prices, and he identified a cycle which he said was roughly 40 months long. And the theory he put forward was that it was a result of what you see in terms of the buildup and depletion of inventories, where from if you can imagine, you get a general increase in demand for particular goods and services, or here I was looking at goods, entrepreneurs would respond to that by expanding output. Expand output, but up until such a point where the market becomes saturated with the goods. And so you have a relative demand and drop, which results in prices dropping. And then that signaling mechanism will eventually get back to the entrepreneurs, because they're just building up inventories. Of course, they slash prices, they reduce employment, they reduce all the factors of production, you get a downturn. And then you start the process again. So you've got this sort of self-regulating process, which is pretty evident, say, in the oil market. You know, how at certain oil prices, that will start bringing up more businesses online. The marginal businesses start coming online, right? But then eventually they start flooding the market with the increased supply. Prices start coming off, and then come off to a level where those marginal businesses start going out of business, up until you have a shortfall in terms of supply, and just kind of start off again. So he identified this cycle with a period of roughly 40 months, which, interestingly, if you do like a spectral analysis of a lot of indicators nowadays, such as the S&P 500, or look at gold prices, you find that one of the main cycle beats corresponds to the kitchen cycle. That's why it's lasted so long in the literature. Mm-hmm. That is one such example. So tracking such things to, again, it starts giving a little bit of granularity on that larger picture. So identify periods where maybe you're now coming off a trough in that cycle. Probably a good time where you start building, for the medium to longer term, so-called risk-on positions, or coming into a time and period where you might be actually heading into the trough. Okay.
So I get cycles are important. You can have an idea on the cycle based on where you see policy. You can do some analysis on the actual data, historical data, to identify repeatable time cycles within your time series.
Exactly.
What about the actual charting techniques? Like,
now we come to that, right? So that's the next level down, right?
Right.
And in that, what nowadays I'm very systematic about how that approach, right? I literally have a model built based on techniques I've used over the last decade and a half, which is essentially a state space model. It is giving me an output, simply 4 states I'm looking at 4 major markets in stocks, bonds, metals, and energy. The 4 states are either buy the dip, self-explanatory. It's contra, sell the rip. There's mind the squeeze and sort of mind the flop, right? So it's just language to point to the sort of character that I am expecting from a particular market. Is it in the sort of uptrend where I want to be buying weakness for a market that I expect to remain in an uptrend, or the reverse? Or is it, say, a market that has been experiencing some weakness, but historically the indicators are pointing to the risk or the likelihood of a squeeze?
Okay. And the indicators you mentioned, you said the indicators are pointing to, so can you divulge?
In that, yeah. So there I'm using a selection of classic momentum indicators.
Okay.
Such things as MACD, such things as RSI, etc.
Okay.
Right.
So you're not using those like the basic oversold, overbought indicators, right?
No. So
okay.
Yeah, I don't have such hard coding as say such a level's overbought, such a level's oversold. No. This is more of a we'll get into it on another day, just how exactly the input from the indicators is. But what that is giving me is a market regime. Okay. Now, once I have that market regime, I can actually start overlaying some of the more classical, old school technical analysis if I want to tell a story. So for example, such things as Elliot wave. I find Elliot wave very useful for providing context. Providing context, but also for constructing different market scenarios.
Right. Yeah, I agree. I've put an Elliot wave tutorial on my YouTube channel just to know what it means. But yeah, I agree. It does help give you a context. It's not particularly predictive, I don't find, but
no. It depends on the user, right? But then it's when you say it depends on the user, it's just depending on the luck of the user. Because yes, it's open to such wide interpretation, wide interpretation. But it's because of that I find it's useful for those scenarios, right? So you can put yourself in so many different shoes and come up with so many different possible Elliot scenarios. But you can use those, right? You can use those as coming up with some sort of ensemble of forecasts. Because that is truly how I look at the market, right? It's kind of like weather forecasting, right? A much difficult version of weather forecasting. Because in weather forecasting, you know the rules, it's physics, right? But still, it's incredibly difficult. With us, in the markets, yeah, much more difficult. So making one single prediction is not probably the way to go. It's about having an ensemble of forecasts, having a wide array of scenarios that you're looking at and are prepared for, certainly in terms of your own positioning.
And then do you attach probabilities to those outcomes? And you might have a favored outcome that you think is more likely because more of the stars are aligning to suggest that that's the case.
So that's what's coming from the level we described before. The actual statistical model that's giving me those regimes is that in effect is giving me what's most likely based on the market's history itself.
Right.
On that comes my overlay of, okay, this is what could be happening, but also this also could be happening. But these are the sort of scenarios that are most supported by the current regime. If the regime is saying buy the dip, then of course I'm thinking the likelihood of the more say ugly scenarios, for example, large sell-offs or whatnot, is probably a little bit premature or wrong.
And to identify like entry levels or target levels of things, I mean, is the is your preferred approach like Fibonacci? Is that because a lot of people use that in technical analysis, right? Seems to be
Yes.
the most used or one of the most used techniques to identify levels. Is that something you support as well?
Fibonacci is great if you know how to use it.
Okay.
The classic use of Fibonacci, the classic way people use it is probably a waste of time.
And what is the classic way people use it?
The way I saw people using it 15 years ago, the way I was using it 15 years ago, where you just pick a ginormous swing and shove your Fibonacci grid there and say, oh, here's my 38 point, whatever, right? You know, that, which obviously I became frustrated with very quickly because I said, hey, this doesn't work.
And it's,
right?
and it's just arbitrary, right? It's
very arbitrary, right? There is an art to it. And that I only learned after many years of trolling the literature, where basically I think the only two individuals, one of which I remember, who were using what they called Fibonacci confluence, which, you know, it completely blew my mind. What blew my mind, first of all, was the accuracy of this analyst's levels, yeah. Right? And then once I learned how she was doing it, then I realized, okay, this is how you use Fibonacci then, right? Yeah. But then it turns out Fibonacci is also just one of many inputs you could use when it comes to identifying good trading zones, good trading levels.
I mean, right? Full disclosure, I mean, you taught me, and I'm by no means an expert, but you taught me a bit of the art of Fibonacci confluence, and I use it religiously. Yeah. When I'm trying to identify my own levels, and it does amaze me, the accuracy that it comes out with a lot of the time. And, you know, that leads me on to my next question is like, do you see certain markets respect the levels more than others? And is that just completely random? Or do you think that there's some rationale to like why a market might respect technicals more than say some other market?
That is a very difficult question for me to answer. I have no idea how to answer that. Put it this way, right? So in the last few years, there's something I came across. It was, I don't know who developed the idea, but it was being used by not necessarily an analyst, but this guy's just a researcher. I think he's a former Russian nuclear physicist or something like that, right? And he develops a lot of interesting toys, so to speak. He had one called Turning Point Analyzer. And effectively what you do here is you can shove in a time series of whatever your favorite market. And you define a certain swing threshold. So say, for example, 10%, right? And then it'll go through the entire history of your time series and mark with swings every time you had a 10% or greater move. Mm. And then it performs a statistical analysis of the relations or proportions of all those swings. Mm. It'll do them pairwise in terms of every swing relative to the most recent one. Then you can do the swing to the one before that, the one before that, and it continues to like 10 swings back. So you just have all these sort of relationships for any market for effectively turning points. You know, what are the sort of proportional swing moves that this particular market likes to mark its turning points? Mm. And what you'll find is, yes, there's some markets that these turning points start clustering, because yeah, you can draw a histogram of this, right? You'll find them, they start clustering around certain Fibonacci relationships, but that's quite rare, right? But you do see there are certain levels to which a market tends to mark its turning points in terms of the relationships between these swings. And that sort of statistical analysis, when I started adding it to say Fibonacci confluence and the other techniques we've talked about, then things just became, it's like you're looking at things from 2 dimensions. Now you're not actually seeing depth, you're seeing 3 dimensions, right? Because yes, you find markets can be different, right? It's not one size fits all.
Yeah, well, that's something you've said to me before. It's like, each market has its own character, right? So when you're doing some sort of momentum indicator analysis on a market, you don't just say RSI below 30 is the level for every market. You basically say, what is the character of this market, right?
And
what
also,
is, you know, what is the important level on the S&P's RSI, right? What is the important level on oil on its RSI? And they can have their individual levels and respect their own levels. And that is almost like the unique signature of a market that takes into account all of the actors within that market and their psychology and the way they behave, and, you know, and it's all amalgamated into one indicator that you can then kind of try to get a feel for, basically, right? So that's kind of how I understood it.
Yeah, agreed. Right.
All right. Well, we're running a bit low on time, but have you got any last question? Have you got any particular setups right now that you see that are very clear in your mind from a technical perspective? You know, whether it's equities, whether it's commodities, whether it's crypto, whatever it is you're looking at. Have you got a favorite setup that you just think it's all pointing very clearly to a certain scenario in your mind?
Well, there are a few, right? You know, as you've probably seen, I've been blogging a few things whenever I think something interesting is on the cards. So one interesting setup at the moment is the US dollar. I think I put out something in July. Something in July was the dollars were very strong about cyclical headwinds that were turning up in the second half, right? And then I put some statistics to go up with that as well, because I think you know, the DXY is something where we have a nice long history of time series, and yeah, I think that's an example of where I was using all those bits of the system we talked about to point to the position that I wanted to take, right? So, and I've been short dollar for, you know, a few weeks now, based on the model output, based on those cyclical inputs, because the dollar has this seasonality of having a lot of weakness around this time of year, heading on to, say, October, November.
That's interesting.
But you know, if you read that report, you will also see how the Elliot scenarios can be used as an overlay into that to show, okay, this is likely what is probably happening at the moment. Of course, there are other potential outcomes, but based on the model outputs, based on the cyclical inputs, I'm looking at being short the dollar probably for the remainder of this year. And, you know, the primary scenario I'm looking at on the euro is possibly euro to 124, 125, whether you're looking at sterling as well, to new cycle highs, right? Looking at, well, certainly the dollar to making new cycle lows from where it is currently, before we get what will probably then be the next upswing in the dollar.
And that's interesting, because that analysis you've done is all purely based on technicals, whereas a lot of people, when they're trying to build their view on the dollar for the next 3 to 6 months, will be looking completely at policy and saying, what is the relative kind of state of play in terms of what the Fed's going to do versus the ECB, what are yields, what are relative yield differentials or real yield differentials, things like. You don't look at any of that, right? You're just looking purely at price action in the DXY. What are the cycles? What's the seasonality? And that's your view is based purely on that, right?
Purely on that. Purely on that. You know, Fed's going to Fed. ECB is going to ECB. How can I say it, right? You can analyze anything that they say. You know, they may end up doing something completely different to what they say, right? So yeah.
I mean, tell people before you go, tell people where they can find out more about you, where they can find. I know you write some articles on Medium. You mentioned blogging. Is that the place? Then
that is it. That is the only place. I mean, I provide links to. I've got a Twitter account based on your recommendation, but I just link to the articles that I occasionally put up on Medium.
You do link your Medium articles onto your Twitter. So
Exactly.
what's your Twitter handle?
I believe it is Trading Shinobi.
Trading Shinobi. Okay, fine. That's where people can find Kay. We're going to call it a day for this one. Kay, really appreciate you coming. It's
Thank
always
you.
great. Always great to chat to you. I always learn so much. You've taught me a lot about a lot of things. I'm sure you're going to keep doing that. And I'm going to bring you back for sure, right? So maybe in a few months we'll come back and see if your prediction on the dollar turned out to be right. Yeah?
No problem.
All right, man. But take care of yourself and thanks a lot.
Thank you.
Thanks for joining us today. I hope you enjoyed the episode. To learn more about Options Insight and our trading community, please visit us at www.options-insight.com, or you can subscribe to our YouTube channel and also follow us on Twitter at options_insight. Until next time, thanks.